This is episode 246 of Zen and the Art of Real Estate Investing with my guest, Gary Lipsky. Gary is the president of Break of Day Capital. He has 20 years of real estate entrepreneur experience focused on multifamily syndication now, well over 3,200 apartment units, over 280 million. It's always more whenever I do this. Gary, welcome to the show.
Jonathan, thanks for having me. Appreciate it.
Yeah, I always like talking syndications because, as I was saying in the pre-call, can do a lot of syndication shows, but everybody's view on them and why they got into them is different. But so how did you get started? When was the first time that you remember real estate being of interest to you?
So, I wish my parents really talked about it, and they never did. But really, late 20s, early 30s, I was looking for my first house and I was in debt. Didn't have any money down, and just trying to find the right neighborhoods, and found like a fixer, in Mar Vista in Los Angeles.
Yeah.
And that was my first foray. We converted the garage to an office. So I knew I can get $720 for rent to help with the mortgage.
That's pretty advanced though for a first timer. Did you even know what you were doing, or were you just thinking this is just a smart use of space to get money?
I spent a few years really understanding the markets and whatnot. But at then there was no podcast really. Like I was just learning how it's going.
Yeah.
But it laid a seed. I didn't know that I was going to go to real estate at that time.
Yeah.
But I saw, I like the creative side. I like the number side. I like creating, value. And this is over a long period of time, but like I started getting more and more into it and whatnot, and ultimately got into it full time when I sold the business at the end of 2016.
I think a lot of what people are going to face now, where we have a housing shortage, and this will play into potential syndications. And if people want to send their kids to private school, they may have to opt to rent because they're just not going to have a giant down payment, especially not, in California or Seattle and some of these areas that are just high priced. What do you think about that? And has that played a role in how you guys are thinking about multifamily syndications now?
Yeah, depending upon which source you look at, it says we're 3.8 to 7.2 million housing units short. Obviously, affordability is lower than ever, and so there's so many people that need to rent, and we focus on Class B, typically where they don't build new Class B, they'll build Class A because that's the only thing that pencils. So working in that area, it allows us to have the greatest amount of renters, and we could still have a nice, we bought recently 2 1999 products. So there's still some value add component, but it's a high quality property.
Yeah.
We're not trying to get the best rents. It fits right into that middle band,
Yeah, I've been talking about this a lot. I love the point that everyone's building A's. It makes so much sense. But I think if you're new, you're not thinking of it that way. Or even if you're new to syndications, you might be thinking, oh, well, I want to get into an A. But B has a very distinct advantage from what you've said, meaning there's not really competition. The competition is all building higher. So you're really only in competition with the B's around you, or the C's that are trying to get up to B, but they're always going to be behind.
Yeah, absolutely.
Yeah. So is that, how are you qualifying something as a B? I know it's almost like a it when you see it type of thing for each market, but for listeners, I've always tried to help them because the ABCD thing is so hard. D, you generally should know when you see it, but B and C can almost look the same. It could be a geographical issue. So how are you coming up with what's B to you guys?
Yeah, and when we started, we were definitely doing more C's, more bigger lifts. But I would say that, the look of it, because I've seen properties that are 1999 that look 1979. And
Yeah.
I'm like,
Yeah.
I won't, or 1969. And I'm like, I won't buy it. There's nothing I can do to really make this look nicer. And whenever I look at a building, it's like all these different things that we can do to make it look nicer that don't cost a lot of money. Obviously, paint and landscaping and some amenities like a dog park, but a good tenant base. So I'm looking for median household income in the area, good shopping. It's, I'm not necessarily looking for Nordstrom's, but,
Yeah.
a Costco or Walmart, just something, decent, um, re- uh, retail and commercial spaces that are filled up, not empty, parking lots.
There's plenty of syndicators who, they made that large reach at the wrong time and now they're in trouble. So how do you make sure that you don't get that kind of adult FOMO and just like, really, everyone says the Southeast is crushing it, but we're so far away. A lot of people will do it.
Yeah, I mean, it's staying true to, our criteria and what we believe. And um it just shows for my whole team. I've got five other people that work for me and they all invest in our deals. And when we do DD, everyone goes,
Oh, that's
for
awesome.
operations people. So they really know what, when investors are calling, that they can all speak to it and they believe in the product. And so we're all galvanized, to take down a deal. And we just lost one a couple of days ago that we were all like really excited about. And everyone was like a collective, like so disappointed. But
Yeah.
literally like an hour later, a broker that I've done 4 deals with called me and he's got one that just over the phone, I could tell like it's right down our alley. We haven't fully underwritten yet, but it's just something that we'll, probably aggressively go after because it clicks the boxes so far
Yeah.
on what we look at.
Yeah, I like that the whole team goes to see it because, as you said, then just if they're talking about it, they get a random contact. They're not as detached from it. A team of 50, of course, everyone's not going to be there. But if you're on the phone talking investments, or if you're just someone who, hey, wants to put an accredited investor in, it's very hard to get across. Oh, well, what's across the street? I don't know. Yeah. What are the demographics like? I'm not sure. Let me set you up on a call. But if you have to take the time to do that, you might lose the person in the middle. Yeah, and so in terms of your avatar for investors for you guys at break of day, what types of investors are you looking for? Because we talk a lot about people understanding that investing in syndications is generally illiquid compared to a lot of other things. But is there a certain type of person that you're looking for in the way that you guys do syndications?
Yeah, I mean, we haven't completely narrowed it down. We just say the busy professional that doesn't want to do it on their own, because I think
Yeah,
there's a lot of push of like bigger pockets or whatnot to like do these single families on your own. And it's a lot of work. It's a job. And you realize the margins are so small, it's not worth your time. Invest with a team of experts that do this full time. And you obviously have to do your own due diligence. Just because they have a team of experts doesn't mean, their underwriting is good. They're not chasing fees and whatnot. So you really got to know the underwriter, the operator,
yeah, yeah.
first, and then really dive into the deal. But to me, I think that's the best way to be investing, and that really, that's our avatar, that busy professional that wants someone to do it for them, that they know, like, and trust.
Over your years in the real estate syndication field for multifamily, what do you think the most important thing for someone who wants to get into it is to know? Someone who's out there, again, they have disposable income, they're accredited, they are a little bit busy, but they're willing to do the due diligence. I think that's always an important point. What's the most important thing that they should know about syndications when the news has not been so friendly to them for good reason for a lot of ways?
Right? And you're focusing on an investor, correct? Not an
Yeah,
operator?
yeah.
Okay, so first off, they should buy my book, Invest Smart, Spotting Red Flags in Real Estate Syndication. There you go.
Oh, good plug too.
Right. But really get to know the operator. You're betting on the jockey first. That's the most important thing. What's their communication style? Do they get back to you right away, or is it takes a long time? And if you invest with them, it's not going to get better. What's their track record? Have they done a number of deals in this market? Have they been successful? If they talk about their track record as being perfect, you don't want to invest with them, because they either one haven't done enough net deals or they're lying. Because
Yeah,
like any business, you're it's impossible to bet 1,000%. There's going to be some ups and downs, and you want someone to be transparent and be able to talk about it. I would suggest I'm investing with someone that does it full time and has a team of people that support that person. Because if they're just dabbling in it, or if they're chasing all these different assets, it's really hard to be good. Now, if they have a huge team and they've been doing it for many, many years, then I can understand having multiple markets and multiple asset classes, but having a focus is really important. And I would also, once you start looking at the deal, how is the money returned? Is it 100% of the money back to investors first?
Yeah.
Are there super high fees where the operator is getting all of this money up front, and so as an investor, you're really not protected. And so it's really important to make sure, like for our investors, they get a pref, they get 100% of their money back first, then we go into the split. So if we perform well, then we all share in the profits. And if we don't, then investors are protected, most importantly, first.